If you're an investor who has a small portfolio of some of that rural recreational land, what are the tactics to get that sold, getting out from under that? I mean, looking at owner financing, lowering the price. I mean, how do you think about people managing their dispo portfolio?
I have had a lot of conversations about this lately with friends and colleagues, and just it seems like everyone's struggling with this. And I'm about to try to figure out what I need to do because we just did an audit of our loan portfolio, and man, I was looking at something and I was like, we are like my master spreadsheet. I'm like, we are missing some properties. Like,
Mhm.
I just know there's properties I own that aren't on this spreadsheet. And we went and looked and found a few properties that weren't on the spreadsheet. So I have like 10 or 15 rural properties right now that I'm trying to get moved after not really doing a lot of super rural stuff, I will say. Okay, 2, 3, 4 hours away from major or secondary metros. I think you got to go back to the playbook that's always worked is owner financing, right? And I think I'm more mature now in this business than I was when I started. And so as I look at it and I say owner financing, I'm not necessarily thinking I'm going to keep all the payments and the loans. Like maybe I need it or a listener needs access to the liquidity in that portfolio. That might just be thinking about doing the loans correctly. There's plenty of discount cash flow buyers out there. If you like, there's Paper Stack, there's 1,000 different Facebook groups where there's a ton of note buyers that are in there. As long as you look at and you do your seller financing correctly. So to answer your question, I think it's seller financing and lowering prices to really bring in like the affordability aspect of the
Mhm.
property. Because a lot of people still want to, like I've proven to myself, plenty of people want to buy rural land. It's just depending on can they afford it. And just because you overpaid for a property, or just because you bought a property that you didn't expect you had to sell on terms, market does not care, right? Market could care less about that. We just are where we are. And if your property's not selling, either not priced low enough cash, or you don't have, there's not access to liquidity, right? Seller financing is a liquidity pool. It's just you, but it is liquidity, right? And so there's no liquidity there. And I think that the secret to getting stuff sold is what I did back in 2016, 17, 18 is just beat the market on pricing and financing. That always gets things sold, frankly. And I think the tweak you can do is if you're in that, because a lot of people are in the ballpark of, I bought a bunch of land that I thought I was just going to flip for these exorbitant prices that have now come down, and I can't seller finance. I'm gonna be underwater. You need to really focus on seller financing it properly. Good interest rate, good borrower. Simple. Okay.
Mhm.
Good interest rate, good borrower. And maybe one third one is like good loan to value, right? So if the property's worth 100 and you get 25 down or 20 down or whatever, you want to be kind of like a note buyer. Because at the end of the day, if you need to sell these notes, you're going to be talking to note buyers. Note buyers love to see sub 70% LTV, right? So if there's $100,000 of property value and there's $75,000 of unpaid principal, there's only 25% equity in that portfolio. A lot of buyers want to see 30% plus just because it hedges the downside risk, right? If the market does adjust 30% down, that note buyer has a big cushion to land softly, right? And
Mhm.
still get out of it evenly. So that might mean that you take less money. That might mean there's a lot of consequences that it could mean, right? But at the end of the day, that's what note buyers are looking for. Good borrower, good loan to value ratio, and I don't remember the third one I said. Something else, right? But that's really what we think about. Good interest rate, good loan to value, good borrower. And maybe even a fourth one, decent asset, right?
Mhm.
Understand what the asset is. If it's a bad asset, just say it's not a great asset and expect to sell it at a further discount. Like when I go look at, I get people send me notes all the time. If I'm looking at a lakefront buildable property that's got 50% unpaid principal. Okay. So I've got 50% equity in this deal. And I'm buying it at a cash flow discount of 10, 15, 20%. Call it 15%. And then I go look at an 80-acre tract in Costilla County, Colorado, where your market value versus my market value change. Like I'm going to be very conservative. You're going to be optimistic about what the market value is. And so if I look at it and I'm like, dude, like even with the down payment that you took, I think that the unpaid principal amount here is about what the market value is, right? If the market corrects, borrower stops paying, I'm underwater on this deal. I would much rather just go pay more money for the lakefront lot, for the loan
Hmm.
on the lakefront deal, than deal with this one. And there's always a number, right? If I can give you half of what you're asking for, so I have that cushion, but that's probably not going to be good for you. And so for people who are stuck with the inventory, I think it's just thinking strategically about how do you lower prices in seller finance, and if it's more than one property, because I I was talking to somebody about this yesterday. There's different note buyers. Okay, if you're familiar with like real estate debt and you're a personal investor who's say sub $5 million in net worth, man, I tell people if I ever want to just quit working for a year, I'm just going to take my cash. I'm going to go buy land notes because I can average about 18% yield on those. I'm just going to hang out and just harvest my 18%. So there are people like me who buy notes just purely because it's much higher than inflation. It's much higher than market, what I'm going to get in the S&P or what I'm going to get with Goldman or whatever, and I understand it very well. So I'm kind of like a personal buyer, right? And then there's this big gap in the market, and then there's like institutional buyers. And so you need to realize who you're targeting. For everybody, one $8,000 loan probably isn't going to get anybody out of bed, right?
Hmm.
A portfolio of 12 $8,000 loans that are $100,000, that's going to wake you up to take a look at it further, right? But on the flip side, a large portfolio of $2.5 million, too big for me, right? It's too big for me to go take down unless I go raise the money. And I don't really want to do that to harvest 2 or 3 points in the middle. So then you're starting to talk to larger funds, more institutional sized buyers. And frankly, they like to write $5 million checks. So there's kind of this gap in the market too. And you got to realize where you're playing, right? So you want to package your deals up into a size that makes sense for the person that's buying. Because like a lot of people who are new to it, they're just thinking about it as individual, like as individual properties. Oh, I got these 4 land notes. But as the other side of the screen or the other side of the buy the this equation, the buyer of the debt, they're thinking about it completely different terms. How much money am I laying out? What's my cash flow? What's my yield on my cash? And so I think thinking about your inventory and how you're going to discount and sell it on potentially seller financing, you should also be thinking about who's going to buy that portfolio on the other side, right? I think a really good sweet spot for people is to create portfolios. If I were to go sell my note portfolio off right now, I'd break it up into $100,000 to $200,000 chunks. And I'd put some good assets in there, I'd put some medium assets in there, and I'd put a couple bad ones in there. Or quote unquote like the less desirable ones.